In the wild, unpredictable world of crypto, stablecoins often feel like a lifeboat in a hurricane. While Bitcoin, Ethereum, and your favorite altcoins are taking a nosedive, coins pegged to the US dollar seem to hold their ground, stubbornly staying around that $1 mark. But is this stability real, or just a clever illusion? Are stablecoins the safe harbor we all hope for, or are they hiding risky shores just beneath the surface? Let's cut through the noise. When everything is bleeding red, stablecoins offer a place to park your value, a digital equivalent of holding cash. But the big question we are exploring today is, for how long? With the crypto landscape constantly shifting, we need to understand if these digital dollars are truly a fortress for your funds or a ticking time bomb. By the end of this video, you'll know exactly how to navigate these waters and decide if stablecoins have a place in your 2025 strategy. So, why are stablecoins suddenly such a big deal? It's not just retail investors like us talking about them anymore. The big players are moving in. JPMorgan analysts are forecasting that the soaring adoption of stablecoins could crank up demand for the US dollar by an incredible $1.4 trillion by 2027. Think about that. And the stablecoin market itself, which is already valued at hundreds of billions, is projected to potentially explode to $1 or even $2 trillion in the coming years. This isn't some niche corner of the crypto world anymore. What this data tells us is that stablecoins are rapidly evolving from a crypto trader tool into mainstream digital cash. They are becoming the bridge between traditional finance and the decentralized future. For you, the investor, this is a critical signal. When the market's crash and panic sets in, stablecoins aren't just an option. They're becoming an essential part of a smart financial toolkit, a way to preserve capital when everyone else is losing their shirts. This transition to the mainstream means more liquidity, more use cases, and, importantly, more regulatory scrutiny, which could lead to even greater stability. We are watching a fundamental piece of the new financial system being built right before our eyes. Alright, so how do these things actually work? How does a digital token magically stay pegged to $1? The secret is in the reserves. The most reputable stablecoins, like USDC or USDT, are what we call fiat collateralized. This means that for every digital dollar they issue, there's a real dollar, or an equivalent asset like a US Treasury bill, sitting in a bank account or a regulated reserve somewhere. It's a one-to-one promise. You can redeem your digital dollar for a real one. For example, Circle, the company behind USDC, publishes regular attestation reports to prove they have the reserves to back every single coin in circulation. This transparency is what builds trust. However, not all stablecoins are created equal. We all remember the catastrophic collapse of Terra USD, or UST. That was an algorithmic stablecoin, which tried to maintain its peg using complex code and another crypto token instead of real-world assets. When confidence wavered, the whole system spiraled to zero, wiping out billions of dollars. The lesson here is crystal clear. Transparency is everything. The stability of your stablecoin is only as good as the assets backing it. So, a simple rule of thumb for staying safe is to stick with reputable, well-established coins that provide clear, audited proof of their reserves, and use them on regulated, trustworthy platforms. Okay, let's get practical. You understand why they matter and how they work, but what can you actually do with stablecoins, especially when the market is a rollercoaster? Here are a few key strategies. First and foremost, think of stablecoins as your portfolio's emergency brake. When the market starts to tumble, converting a portion of your volatile assets like Bitcoin or altcoins into a stablecoin like USDC can lock in your gains or cut your losses. It allows you to step off the ride and protect your capital without completely exiting the crypto ecosystem. Second, don't just let your digital dollars sit there collecting dust. One of the most powerful uses for stablecoins is earning passive income. You can use them in DeFi protocols for yield farming or lending, or on centralized exchanges for staking. The interest rates you can earn often significantly higher than what a traditional bank savings account would offer. This turns your parking spot into a productive asset, making your money work for you even when you're waiting on the sidelines. But here's a crucial piece of advice. Keep your positions manageable. While earning yield is great, don't get greedy and go all in on a risky, high APY protocol. Remember, the primary function of a stablecoin in your portfolio is safety and liquidity. It's a temporary safe harbor, a strategic tool for managing volatility. It's not a get-rich-quick ticket. Use it to preserve capital, earn a reasonable yield, and wait for the right moment to redeploy back into the market. Now, it's easy to hear stable and think risk-free, but that's a dangerous assumption. Stablecoins absolutely carry their own set of risks, and you need to be aware of them to avoid a false sense of security. The biggest risk, as we've touched on, is reserve transparency. A stablecoin issuer might claim to be fully backed, but are they really? Without regular, clear, and independent audits, you are essentially just taking their word for it. A coin that is NT fully backed could depeg and lose its $1 value during a crisis, just when you need it most. Another major risk on the horizon is regulatory change. Governments and financial regulators around the world are paying very close attention to stablecoins. New rules could be imposed at any time, affecting how you can buy, sell, or hold them. A sudden crackdown could freeze assets or force exchanges to delist certain coins, creating chaos. This regulatory risk is real and unpredictable. There's also smart contract risk if you're reusing stablecoins in DeFi. A bug in the code could be exploited, leading to a loss of funds. And finally, there's custodial risk. If you're holding your stablecoins on a centralized exchange, you are trusting that exchange to keep your assets safe. As we've seen with exchange collapses in the past, that trust can sometimes be broken. Understanding these risks isn't about scaring you away, it's about empowering you. Knowing what can go wrong helps you plan for it, diversify your stablecoin holdings, and use them as part of a safe, intelligent crypto strategy. So as we look toward 2025, what's the big picture? It's essential to shift your mindset. Stablecoins are not a speculative investment you buy hoping the price will 10x. They are a utility. They are digital cash, designed for stability and efficiency in turbulent times. Their purpose isn't to make you rich overnight. Their purpose is to keep you from becoming poor overnight when the market panics. Think of it this way. You don't buy a lifeboat hoping to get rich from it. You have a lifeboat so you can survive the storm. The growing institutional adoption from giants like JPMorgan and others is a massive vote of confidence. It signals that stablecoins are becoming a permanent, foundational layer of the future financial system. They will likely facilitate everything from international remittances to tokenized real-world assets. But this powerful future is only accessible if we, the users, are smart and prudent. We must demand transparency, favor regulated options, and understand the inherent risks. So, are they a safe harbor or risky shores? The answer is both. Used wisely, they are an indispensable safe harbor in the crypto storm. Used recklessly, without due diligence, you could find yourself shipwrecked on risky shores. It's all about how you navigate. If this breakdown helped you better understand stablecoins and how you can use them to protect and grow your crypto portfolio, do me a huge favor and hit that subscribe button and turn on notifications. Every week, we take the chaos of the crypto market and break it down into clear, actionable strategies, helping you turn volatility into your advantage. Thanks for watching, and let's get smarter about crypto together.